Here's the paradox. Private valuations keep rising, while actual cash out events are scarce. In theory, that shouldn't happen. If exits are rare, prices should soften. But instead, late stage rounds still clear at eye catching numbers. Expected listings make headlines, and founders announce pre IPO milestones like their championships. Reflective, the IPO, once the finish line, is increasingly just the storyline. And that shift quietly rewires incentives across venture, growth equity, and startup leadership. Over the last few cycles, capital formation outpaced exits. There's abundant private capital, crossover funds, sovereign wealth, corporate VC, growth equity. Meanwhile, public markets have been picky. Higher rates, tighter index standards, longer paths to profitability, a post-SPAC hangover. The result? A market suspended between abundant private money and constrained public liquidity. Think of the IPO as having split into two roles. Historically, it was both financing and exit. Today, for many companies, it primarily serves as a narrative event, a public validation, while real liquidity is pieced together quietly through secondaries, tenders, structured deals. And here's the mechanics. First, mark to story versus mark to market. In private rounds, terms protect downside. Preferences, ratchets, pro rata, the headline, valuation travels. The terms determine reality. Valuation is not value. Public markets force continuous discovery without scaffolding, and that discovery may disappoint, companies delay. Second, TVPI versus DPI. Paper gains versus cash return. Funds can raise on TVPI, but LPs live on DPI. If marks rise without payouts, valuations can climb without reconciliation with cash. Third, the signaling loop. A mega valuation reassures customers, attracts talent, improves operating leverage, which justifies the next markup. Narrative begets numbers, numbers beget narrative. Fourth, shadow liquidity. Tenders, buybacks, SPVs, quiet, selective, partial de-risking, without the bell ever ringing. Fifth, the cost of being public. Compliance, quarterly pressure, team coverage. If private capital is available, staying private can be rational. If you're a founder, treat the IPO as financing, not the exit itself. Plan liquidity separately, negotiate tender windows, set expectations early. Narrative inspires, but cash pays the vendors. If you're an investor, optimize for DPI, not deck slides. Understand the preference stack, model extended lockups, plan for stage liquidity, not one big event. If you're an employee, paper gains are not spendable. Clarity on exercise windows, taxes, liquidity programs matter more than headlines. In today's market, the IPO is no longer the exit, it's actually the narrative. Valuations rise without frequent cash outs because valuation is now a cross market signal. Shadow liquidity replaces full exits, and listings validate stories more than they distribute cash. For founders, build to survive price discovery, not just the listing. And for investors, prioritize real liquidity pathways. For operators, plan around tenders, not headlines. And remember, the IPO is a milestone. The real liquidity is designed elsewhere, not louder, just still evolving.